Hey everybody, it's Brandon. Today we're going to talk about CDs, once the darling of the typical retiree, which fell out of favor a little bit when we got into the 2000s, especially the late 2000s when we ran into 2008, and we saw a lot of rate reductions taking place after the 2008 financial crisis. So from that point, it was really not something a lot of people used to generate retirement income because interest rates fell so low that it simply wasn't that possible for most average retirees to buy up enough CDs to collect interest sufficient enough to provide them with any sort of income. But since COVID, those days have changed. We're back in an environment where interest rates are quite high, and now people do have the option to purchase CDs and create income levels that are, for the most part, sufficient for their needs. But we're not so sure this situation's going to persist. In fact, the Fed has already announced its intentions to lower the Fed funds rate by 50 basis points, and sentiment is we're going to get another 25 to 50 basis point reduction announcement sometime before the end of the year, bringing the Fed funds rate down an entire 100 basis points going into 2025. CD rates tend to track pretty closely with the Fed funds rate, so you can bet yourself that if the Fed funds rate's going down, CD rates are also going down. And in situations where we're seeing dramatic reductions in the Fed funds rate, we absolutely have seen fast and dramatic reductions in CD rates. I'll give you, for instance, the last time we had CD rates anywhere close to prevailing levels we see today, we got to go back to the early 2000s, late 1990s. And if we look at the end of 2000, you could have bought a CD, a 1 year CD, at just about 5.5% interest annually. So the real rate was like 5.4, 5.45, somewhere in that neighborhood. 1 year later, so now we're talking the end of 2001, national average CD rates had dropped to less than 2.25. So that means end of 2000, for every $100,000 you had put in CDs, you were collecting $5,500 in income. 1 year later, 2001, you go to renew your CD at maturity, and now it's only going to produce you with $2,200 of income. That's less than half. That's going to cause some significant changes for people when it comes to income plans. Now, the likelihood that we're headed into a similar cycle, we don't necessarily have an economic calamity that is on the horizon, we think, although we generally don't know when they're going to happen. But probably safe to assume we're not going to see as dramatic a reduction in interest rates, barring any sort of massive catastrophic situation in the economy. But we're definitely going to see them decline. In fact, Wall Street prognosticators do predict that by the end of 2025, we'll be down probably another 100 basis points. So that's 200 basis points, 2% less than the situation that we're sitting at right now. And you can almost guarantee yourself that the same movement is going to take place with CDs. So, what to do? Now, I know there's a lot of people who are probably of the sentiment that, look, I'm going to collect CD interest until it's no longer attractive because I like the safety and security of CDs. I like the fact that I can go down to the bank and withdraw the money with no hassle. I like the FDIC insurance. These are all things that make CDs attractive to people, especially people of a certain age and of a certain conservative mindset. I get it. The problem with waiting is that what that generally produces for you is a scenario where when you try to buy into other income producing assets, they're not nearly as attractive as they were before the movement in CDs. So as people move out of certain assets, safer assets, CDs, money markets, treasuries, and into other assets for income because they have higher yield, but perhaps they also have higher risk in certain situations, that movement of money definitely declines yield. I'll give you a couple of for instances, just to sort of quantify the scenario for you. Dividend stocks, oftentimes a substitution for CDs when interest rates drop quite significantly. As money flows into dividend stocks, prices of those shares go up. But as the price of shares go up, it doesn't have any sort of upward effect on the dividend payable on those shares. So dividends stay static, but share price rises. This means the effective yield that you can get per share is going to go down. And we see this happening a lot with various asset classes as they become more or less popular. As an example, the utilities sector of the S&P 500, which got hammered a couple of years ago when interest rates first took their initial rise. The cycle has come back around, so to speak, and they're becoming popular again because there is an anticipation for a reduction in broader market interest rates. What this does to yields effective on the sector is drop it. And it's we've seen a massive rise in just the past couple of months in the utility sector. In fact, the XLU, which is generally what we quote when we want to see the overall price levels of the utility sector, it's up 19% in the past 3 months. It's up about 43% in the past 12 months. So think about that for a second. If you're buying an asset that has seen share prices rise by almost 50%, and we haven't seen a change in the payable dividend on those shares, that means you're buying in at an income level that's almost cut in half versus what you could have done 12 months ago. Waiting on that move was not favorable at all. The same thing happens in the bond market. As money moves into bonds, it buys down interest rates that borrowers are going to be paying, so the yield you'll get on bonds is less. And when it comes to the annuity market, which is oftentimes a favored move out of CDs and into something else that also has extreme safety of principal, what we find there is really two things. So first, the interest rate reduction economy-wide puts insurers in a position where they can no longer buy assets at income levels to them that can produce as much margin as they're looking for. This puts downward pressure on income features. But it's also the case that when an insurer issues an annuity contract, there's only so much risk they're willing to expose themselves to. And risk is really expressed by the number of different policyholders that they have that are also benefiting from this feature. So if money pours out of CDs and into annuities to buy up income, eventually insurers reach their capacity in terms of the risk they're willing to assume, and they shut the product down. Doesn't do anything for the people who bought it already. It just means that it's no longer available to new purchasers. So the big takeaway message here is waiting has a certain complacency effect to it. You're collecting income now through high interest rates, and that all looks great, but it's not going to last forever. In fact, it's going to work right up until it doesn't, but there won't be a whole lot of warning about that in most cases. And by the time you've come to the decision that, okay, interest rates are sufficiently low, it's time to move out of these CDs and into something else, there's a lot of other people who will have already made that decision and have already made that move, and they'll have made the other options much less attractive to you. Now, one other thought for those who aren't necessarily buying CDs for income, but rather just a safe accumulation because of the interest rates that are payable on them. Be very, very careful about re-entry at maturity. Banks have a funny way of not offering their current CD holders the best CD provisions that they have out there on the open market, and so you may re-roll or re-enroll in a CD that has less favorable terms than somebody who walks in the door and says, "Hey, what are your CD rates?" Um, we can be upset about that all we want, but that's how a lot of banks function. So if you're doing this simply for the accumulation, that too could be a scenario where other options will get less attractive as you wait. But if you insist on staying and you are planning to re-up at maturity, just make sure you check on what the bank's array of options are at the time that your CDs mature. Otherwise, you may end up with something that's a little less ideal.